A customer signs a $50,000 equipment lease this morning. The broker who structured that deal walks away with $4,000, and the customer never pays a cent out of pocket for it. Here's exactly how that money moves and what it means for you. Before we get into the numbers, let's clear up the biggest myth in this business. The borrower does not pay your commission. The lender does. When a lease is funded, the finance company pays you a fee for bringing them a qualified deal. That's why you can charge a customer nothing up front and still get paid. The lender builds your fee into the deal. There are three main ways equipment finance brokers get paid, and most use a combination. First, the margin. The lender gives you a buy rate, their base cost. You quote the customer a sell rate a little higher, and you keep the difference. On a $50,000 lease, even a small margin is meaningful. Second, a percentage of the equipment cost. Many lenders pay a flat commission based on the deal size, commonly 3 to 8% of the financed amount. Third, flat fees and overrides, a set dollar amount per funded deal, plus bonuses when you hit volume targets. Now let's put real numbers on it. Say you finance $50,000 of equipment. At 5%, your commission is $2,500. At 8%, it's $4,000. That's the range a healthy deal lives in. But here's the part most people get wrong. You don't get paid at the application, you get paid at funding. The lease has to be approved, the equipment delivered, and the lender has to book the deal before your commission is released. Timing matters more than new brokers expect. On a typical deal, you're looking at days to a few weeks between submitting the application and seeing your commission. Some lenders pay on funding, some on first payment, some net 30. That gap is why cash flow discipline is the difference between brokers who survive and brokers who quit. You're building a pipeline, not collecting a paycheck on Friday. Here's the honest part. Not every deal funds. A deal can be approved, then fall apart at the door. The customer's credit changes, the equipment doesn't deliver, the borrower changes their mind. And when a lease is cancelled or clawed back early, your commission can be reduced or reversed. That's why the most important skill isn't filling out applications, it's qualifying. A deal you never submit is free. A deal you submit and lose costs you time and sometimes your fee. So here's the debate every broker has to settle. Do you want a higher commission on fewer, bigger deals, or a steadier flow on more, smaller deals? A $200,000 deal at 5% pays $10,000, but it might take 3 months to close, and it might fall apart. Three $50,000 deals at 5% pay $7,500, and they're easier to source and close. There's no single right answer. Your answer depends on your market, your lenders, and how much risk you can carry. The biggest lever on your commission isn't the customer, it's your lenders. Brokers who fund volume consistently get better buy rates, which means more room to earn on the same deals. That's why successful brokers treat lender relationships like a sales asset, not an afterthought. One lender you can rely on is worth more than 5 that pay higher but approve nothing. Let's be realistic about what this looks like early. Your first funded deal is the milestone that changes everything. It proves the model works. After that, it's a volume game. 2 funded deals a month at $2,500 average is $5,000 a month. That doesn't happen overnight, but the math is straightforward. And that's the point of this channel, showing you exactly how the math works. If you're serious about becoming an equipment finance broker, subscribe to Equipment Finance Academy and visit equipmentfinanceacademy.com for the full training. Whether you're starting from zero or trying to close bigger deals, the playbook is the same. Understand the money, qualify hard, and build your lender network. This is general education. Always research the licensing, tax, disclosure, and compliance rules for your state and your lenders before you start. I'll see you in the next one.